So let's look at the determinants of interest rates. If you look at this equation up here, it's saying that the interest rate is equal to the sum of all of these strange letters that are defined down here. Well, this is like the theoretical way that we define an interest rate. We don't really ever find like R star, inflation premium, default risk premium, liquidity premium, and maturity risk premium. We just have those numbers and we just add them up and we say, oh, okay, that's the interest rate. This is just how we think about it theoretically. So we'll talk about that more later. So let's look at the first one. We've already talked about R. That's like what we would see if we were looking for like let's say a corporate bond for ExxonMobil. How much, is the interest rate on it? It would be R and say it's 6%. Then R star, we talked about that. That was the real risk-free rate. That's if no other inflation or anything else was involved. It's just your real rate of return all by itself, no inflation included. The inflation premium is a premium added to the real risk-free rate of interest to compensate for expected inflation. $100 today will purchase more than $100 5 years from now, and that's because of inflation. The default risk premium is a premium based on the probability that the issuer will default on the loan, and it is measured by the difference between the interest rate on a U.S. Treasury bond and a corporate bond of equal maturity, liquidity, and other features. So basically, default risk premium is the risk that the company goes bankrupt. Liquidity premium is added to the rate of interest on securities that are not liquid. So a liquid asset is one that can be sold at a predictable price on short notice. For example, a house is not a liquid asset. A CD, a certificate of deposit, is a liquid asset. I can get my money out of a CD really quickly. I can't sell my house really quickly unless I want to lose a lot of money. The maturity risk premium is a premium that reflects interest rate risk. Longer-term securities have more interest rate risk than shorter-term securities. And so this MRP is added to reflect this risk. Interest rate risk is the risk of a capital loss due to rising interest rates. As interest rates rise in the market, bond prices fall in the market. If we look at this chart, this is a very useful chart, by the way. Starting at the top, short-term Treasury securities include only an inflation premium. Long-term Treasury securities contain an inflation premium plus a maturity risk premium. Note that the inflation premium added to long-term securities will differ from that for short-term securities unless the rate of inflation is expected to remain constant. The third line, the rate on short-term corporate securities, is equal to the real risk-free rate plus premiums for inflation, default risk, and liquidity. The size of the default and liquidity premiums will vary depending on the financial strength of the issuing corporation and its degree of liquidity, with larger corporations generally having greater liquidity because of more active trading. And in the fourth line, the rate for long-term corporate securities also includes, besides all the other maturity risk premiums added, it also includes a premium for maturity risk. So long-term corporate securities generally carry the highest yields of these four types of securities. Notice on this slide that every security has an inflation premium. Short-term treasuries to long-term corporate bonds. And you can think of a short-term treasury as like a treasury bill and a long-term treasury as a 10-year treasury note. A short-term corporate bond could be like a 1-year corporate bond, and a long-term corporate bond could be a 20-year or a 30-year corporate bond. Notice that the maturity risk premium is only added to the long-term types of bonds. The default risk premium is only added to anything that's labeled as corporate. This is because corporations can go bankrupt, whereas we assume the government will never go bankrupt. And then also notice that liquidity premium is only added to corporate bonds because you cannot get your money out of corporate bonds as quickly as you could get your money out of treasury securities. Another point is that you could think of each of these lines as an equation. To find the rate on a short-term treasury, it's R star plus inflation premium. For a long-term treasury to find its rate, it's R star plus IP plus MRP, and so on. So it's like you have 4 different equations here, and based on the problems that you'll be working and that we will be working, you'll need to know this information or have this chart available.